Now, nothing is shocking in the numbers here. Inflation is moderating, it is coming down, but it still remains an obstacle, which makes a 0.25% rate cut seem like the likely decision. The final CPI report before the next Fed meeting has been released. If anything, this CPI report from the Bureau of Labor Statistics should cement a 0.25% rate cut at the next Fed meeting. Now, in this video, we're going to deep dive into this report. We're going to discuss what it means for the economy, for interest rates, and more importantly, what it means for you and me. Now, before we get started, let me just say that if you like content like this, leave a comment down below letting me know what you think. Make sure you subscribe for more content like this and hit that thumbs up button for me. Now, this CPI report shows consumer inflation at its lowest level in 3.5 years since February of 2021. Now, I've mentioned this in previous videos, but if it's your first time tuning in, the Consumer Price Index, it is a measure of inflation for everyday items, goods, and services that people buy. Now, in August, CPI rose by 2.5%, which is down from 2.9% in July, and over the last month, it is up by 0.2%. Now, this index, these numbers indicate that inflation is moderating. 2.5% is oh so close to that Fed 2% target. Now, core inflation numbers, which take out items like food and gas, more volatile items, rose by 3.2% year over year and 0.3% from the previous month. Now, all of these numbers are pretty much in expectation. Some of them from the 0.2 to the 0.3 might be a little bit higher or lower, but none of this information comes in as a shock. These were the numbers that a lot of economists were anticipating, a lot of them pretty much in line. In August, consumer inflation up by 2.5% from last year in August. Now, nothing is shocking in the numbers here. Inflation is moderating, it is coming down, but it still remains an obstacle, which makes a 0.25% rate cut seem like the likely decision. Now, the Fed is going to take this report into consideration. They're going to look at all the jobs data, this CPI data when they meet next week, and I really do think that a 0.25% rate cut is what the Federal Reserve is gonna do. I have been saying that, since the very beginning. I think that that is the decision that they are going to go with. Now, I could be wrong. The Fed might want to try to send a message. They might go with a 0.5% rate cut because they see the cooling in the labor market, and they might want to, give the economy a boost, a jolt, and try to, they might go that direction, but I do not see that happening, especially with inflation going down here, going from 2.9% year over year to 2.5%. It is going down, and I do think that, that 0.5% rate cut, it might send the message that the Fed is here to help and all this, but not all the economy and the stock market, they don't always react the way that you might think to that. If the Fed, for example, if the Fed was to cut by 0.5%, the stock market might go down the next couple of days. People might think, oh, the Fed cut by 0.5%, this is going to be great for the economy, and then next couple stocks are just dropping. People, why are the stocks dropping? The Fed did an even bigger rate. Well, the stock market is reacting to the Fed trying to send a message that we're closer to a risk, and things of that nature. So just understand that if a 0.5% rate cut was to happen, that doesn't mean that the very next day that stocks might go up. And it doesn't, if it goes down for a couple of days and starts to go up, whatever. But just understand how these type of things work. But based off of this data, with inflation coming down month over month and the numbers moderating the way that they are, I really do think that that 0.25% rate cut is the direction that they are going to go in. That's what a lot of economists are saying now after this came out, and charts and polls are kind of pointing into that direction, but it's what I've been saying from the very beginning. Now, also to be noted in all of this information, housing related inflation, shelter, is being really stubborn. The cost of owning a house or even the cost of renting is just so high. It's 5.2% was the increase when it comes to shelter, and this increase in this specific area compared to other areas is contributing to like 70% or more than 70% of core inflation, core CPI over the last year. It's, and personally, I'm a big believer in owning your own house. That idea of having your own land, your own backyard. It's something that you could take pride in. Having ownership. I know there's financial gurus on the internet that you don't need to own a house and it's a waste of money, and people give you all type of weird advice, and I guess you can be wealthy and rich without owning a house, but I'm a big believer in having your own house. Obviously, the appreciation on homes, and it's a way to store money. It's an asset. And yes, you can get wealthy without having one. I understand that, but for a lot of people that would probably like to own their own house, it's the numbers that we're seeing, how high they are. It's a lot of people that might want that opportunity are kind of being robbed from having that opportunity. And we are seeing shelter costs, particularly housing and even renting for people that just want to rent and don't want to own yet. It's taking more of their income as well just to be able to do that, which takes away from recreation and shopping. And that is kind of the stubborn thing with inflation right now. Now, certain things like insurance are up, and recreation and stuff's up a little bit, while gas prices are down a little bit compared to this time last year. The numbers are gonna be different depending on what part of inflation that you're looking at, or what part of service and goods that you're looking at. But shelter is kind of like the sticky one right now. It's contributing to a lot of the inflation numbers, whereas if you were to take that out, a lot of other stuff is very moderate. But also understanding the importance of shelter, other than the food that you put in your body that you need every day, having a roof over your head, somewhere safe and comfortable to live, is one of the most important things. Well, that is being the priciest thing when we're talking about inflation. What's going up in prices? Your home, where you live, is the thing that's going up the most. It's contributing the most. But it's a hard thing to try to fix, because it's out of the Fed's control, really. You're gonna mess with interest rates, but it's the real estate market or the renting market that's separate than the interest rate policy, because the type of spending that people do, it's just a separate thing. And you have to understand that the Fed doesn't really control it. And I made a real estate video the other day discussing how homes are staying on the market longer, and that's kind of changing. But also with the Fed changing interest rates, that's going to have an effect on that market somewhat. But rent, it's its own different thing. Now, a lot of places are coming up. You need more places for people to be able to rent. As population goes up, more people move in, all that type of stuff. But that's kind of like the sticky thing right now with inflation. All in all, CPI data came in pretty much as expected. The data is at a 3.5-year low, 2.5% in August year over year. Still not at that Fed target of 2%, and it's a little bit of a bumpy road to try to get there. And because of all of this, a 0.25% cut by the Federal Reserve next week at their meeting looks like the most likely decision. If you like content like this, leave a comment down below letting me know what you think. Make sure you subscribe for more content like this and hit that thumbs up button for me.